Hello and welcome to the BDO First Call Debt Solutions podcast. I'm your host, Tara Bellio, and you're listening to the first of our two-part series called Credit Score 101. In this podcast, we're going to talk about what you might not know about your credit score. We'll cover off the credit score basics, let's say. Then we'll talk to our licensed insolvency trustees about why it's important to know your credit score, what you can do to increase your credit score, and what you may be doing right now that's hurting it. But before we dive into the Q&A with our LITs, let's start by going over just a few credit score basics. Like I said, it's going to be a credit score 101. So first off, Canada has two large credit reporting bureaus. We have Equifax and TransUnion, both of whom collect, store, and share information about how you use credit. They take all that and they put it into your credit report. And this will have information like what types of credit you have, how much of your available credit you're actually using, whether you carry a balance on your credit cards, if you miss a credit card payment or a bill payment, and every time you apply for new credit. So you may be wondering, how does all this information translate into your credit score? And that's a great question. But the thing is, no one really knows the exact formula for how your credit score is determined by Equifax and TransUnion. But here's what we do know. Your credit score is a 3-digit number between 300 and 900, and you're given points for good credit management, and you lose points for not so good credit management. In a way, your credit score rates your ability to handle credit responsibly. So that's why a lender will check your credit score before approving you for anything like a vehicle loan, a mortgage, or a line of credit. And if it all sounds complicated and intimidating, you're not alone. One recent survey found that only 4 out of 10 Canadians know their credit score. That's why we asked our LITs from across Canada to shed some light on the subject. Even if you already know the basics, there just might be a few things you don't know about your credit score and your credit report. In this podcast, we have Craig Frizik from our Calgary office, Audrey Balduke from our Ottawa office, Jasmine Kalniuk from our Saskatoon office, and Jennifer McCracken from our Vancouver office. Craig, it seems like Canadians are increasingly being bombarded by TV commercials and internet pop-up ads encouraging us to check our credit score for free. Will checking your credit score hurt your credit score?
Checking your own credit score will not lower your credit score. Checking your own credit score is considered a soft hit or a soft inquiry. This is the type of inquiry that has no effect on your score. Alternatively, a hard hit or inquiry about a credit card or a mortgage application will affect your credit score. It's important to keep track of hard hits. These include credit applications and credit checks, applying for credit cards, loans, mortgages, and rental applications. Applying for multiple credit cards or lines of credit over a short period of time indicates a high-risk lender. There are a number of ways to check your credit score for free. Your bank may offer this service. There are also online companies like Credit Karma and Borrowwell that offer this service. You can get a copy of your credit report for free from TransUnion and Equifax once a year. How often and when you should check your credit score? Well, at least once a year and before applying for credit or for renting or a job that requires a credit check.
So Andre, let's talk about credit card debt. For those Canadians who are only making minimum payments on their credit cards, can a credit score be negatively affected by high credit card balances?
Yes, it can. In fact, a TransUnion survey from last year revealed that 4 in 10 Canadians didn't really understand the benefit of making more than the minimum payment on their revolving debt. The key concept here is called credit utilization. So, for example, if you have a credit card with a limit of $10,000 on it and you use $5,000, that's the balance on it, your utilization is 50%. If you use the full limit, $10,000, your utilization is 100%. And we know that the way credit is scored, or that the credit bureau is done, is that the higher your utilization is, the worse your score is. So you should aim to have no more than 50% utilization. And ideally, the optimum borrowing percentage is 30%, in fact. So a low credit card utilization rate is good. High is bad. The reason for this is that the bureaus and the lenders know that people that have a high utilization rate are more likely to default on their loans. So that's why it's important to stay under there. And in terms of a little tip, if you want to really give a boost to your credit score, is if you pay your balance in full before the end of every month, before the lender reports to the credit bureau, that scores very well as well.
People can sometimes take drastic steps when they've made up their mind to pay off their credit card debt, like cutting up their credit cards or even closing credit card accounts. When is it not a good idea to close a credit card account, Jasmine?
There are a number of circumstances where it's not a good idea to close a credit card account. So one of those is that you shouldn't close your only credit card account with available credit. That can negatively affect your credit score because you're then left with credit cards that only have high balances. So it appears as if you've used up all of your available credit. Higher credit card balances could indicate to prospective lenders that you're overextended and at a higher risk of defaulting on a loan. You also shouldn't close your only credit card. Part of your credit score is based on having different types of credit, so it's good to demonstrate that you have experiencing managing multiple types of credit. It's also not a good idea to close your oldest credit card account. That will shorten your credit history, and that could categorize you as being risky to a lender. It may not immediately affect your credit score, but it could affect your credit score later on.
So Craig, how can parents help their older teens build a credit history and a credit score?
Many parents may be unaware that they can help their teen son or daughter begin building a credit history even before they turn 18. In Alberta, the legal age for signing a contract is 18 years old. Co-sign a cell phone plan, get a secured credit card, or add the teen as an authorized user of your own card. Be sure the teen knows that it's important to keep up with payments and practice good credit habits. A warning for parents, though, if your son or daughter misses a payment of a joint cell phone contract or a credit card, it will be reflected on your credit history as well. Ways parents can help their teens create a solid financial foundation before they have a credit card of their own is help them find a part-time job, establish a good banking history with their own checking or savings account, model good credit habits and teach them how credit works. And I think most importantly, just talk to your kids about money. Often when I'm faced with the question of why can't I have it from one of my children, I take that opportunity to discuss budgeting or explain to them that they can have it. They just need to work hard and save for it.
Jennifer, for those people who are considering whether to file a consumer proposal or bankruptcy, when an individual files a consumer proposal or a bankruptcy, will it affect their spouse's or ex-spouse's credit score?
This is a really common question in my practice. First of all, if married or divorced couples don't have any joint debt, the credit score and the credit history of the partner not filing the proposal or bankruptcy won't be affected at all. However, if a couple does have joint debt, there's some things that you should consider. The notation of the consumer proposal won't go on the spouse's or ex-spouse's credit report, but they could be responsible for the entire joint debt. The consumer proposal does not change the operation of the credit contract itself. The bankruptcy also won't go on the spouse's or ex-spouse's credit report, and it won't affect their credit score. But again, the joint cardholder is responsible for the entire joint loan or debt. Any repercussions from taking on additional joint debt is reflected in the credit history and credit score for both borrowers. This includes things like late payments and credit balances.
I'd like to thank our LITs, Craig, Andre, Jasmine, and Jennifer, for providing their insight, tips, and advice. We hope you share this podcast with your friends and family, and remember to check out our YouTube channel, BDO Debt Solutions Canada, for more podcasts and videos. Also, keep an eye out for the second podcast in our Credit Score 101 series, where our LITs will offer some great tips on how you can improve your credit score and rebuild your credit. Until next time, I'm Tara Bellio, reminding you that it is possible to leave debt behind.